Welcome again, welcome back. This is Investment 360 now. We've still got Seppo and Kevin in the studio from the Business Tonight programme, but we've also got a new guest now, and it's Jeff Blount from Cannon Asset Management. Given the Rand's recent wobble, this is the introduction to you, Jeff, by the way. Given the Rand's recent wobble, the question most investors are asking again is whether to invest offshore or not. And if so, how much of their portfolio should be invested in other countries? Jeff Blount is the CEO of Cannon Asset Managers, as I said, and he's here to talk about the past trends and also give us useful pointers in making the decision to take assets offshore. Jeff, I think that the introduction that I just read, I didn't actually write it, but it sort of it gives the wrong impression because it talks about the Rand. That shouldn't be the reason to go offshore, surely.
No, absolutely. I think the Rand is the red herring when going offshore. Generally, people are, they make the offshore decision based on a view of if the Rand's going to strengthen or weaken, and where should we, what is the timing of it? And we think that's more investment speculation than investment management. Interesting enough, the analysis that we've done shows that over very long rolling periods, whether it's whether you buy offshore equities in rands or dollars, or South African equities in rands or dollars, what's more important is the asset you own rather than what the currency does. So, for example, in the 1990s, whether you owned US equities in rands or dollars, you did very well, and relatively in rands or dollars, you did poorly in South African equities. And in the 2000s, we all know the story. We've had great equity returns in South Africa, if you were in rands or dollars. And if you were overseas in the US, you had poor returns if you were buying those indices in rands or dollars. So the point is that it's probably more important to actually look at the asset you own than time the currency. In the long run, currencies tend to wash out. We know a large component of the JSE are rand hedge stocks, so they have offshore earnings. So therefore, rather look at what you're buying than take a speculative punt on where the Rand is going to be, which I might add, we think is incredibly difficult to get right.
Yeah, you and a lot of other people. I mean, everyone keeps on saying it's either going to 11.50 or 8.50, and here it is stuck at 10. Let's just go back in history, because in the introduction I talked about you going back in history, and we can learn from historical experiences, because I think it was 2001, 2002 when the Rand blew off to 14 against the US dollar, 20 against the British pound, and at the same time the overseas markets were looking a little bit toppish. So you got the double whammy by taking your money overseas.
Absolutely. I know there were a number of advisors and financial planners and organizations, even some asset managers, that at the time, did the typical mistake of most investors, and they take the recent past and extrapolate it into the future. So South African equities had done badly through the late 90s. The Rand had weakened out, and there was the currency crisis, so it was a one-way bet. Now, I suppose that comes to the second point that we often make for investors, is that be careful what your liability currency is. If you take that case in point where someone was advised or invested all their money overseas, they would have bought US equities or global equities at high ratings, and the Rand at Rand in a particularly weak point in the cycle, if you want to call it. And over the next 10 years, they got taken to the cleaners. Now, if you've retired in Rands and you're spending Rands every year, you get dramatically poorer over that period. So I suppose the second aspect of this is when you're looking to invest overseas, just be aware of what your liability currency is in, because that's what you have to live in. And so therefore, if you can earn, as a case in point, if the Rand is what you spend your money in, and you can earn 5 or 6% yield in South Africa, as opposed to practically nothing in Europe or the States, then the only thing that can improve your investment return is actually a weakness in the currency. So again, look at your liability currency and make sure that you don't take too much money out of that currency.
Well, let's talk about the actual underlying asset now that you're buying, which is an overseas equity. And let's throw this open to all three of you, because I would contend that since March 2009, the S&P has been on a most terrific run. 4.5 to, over 4.5 years now, we've been in a bull market. So you might be saying to yourself, yes, it's all very well diversifying geographically and going overseas. But on the other hand, historically, 4.5 to 5 years is usually the top, and then the market comes off a bit. What do you think? I mean, maybe Seppo or Kevin have a few words about that.
Look, I think that's an important point. I agree, I think, with everything Jeff's pointed to. I think the other thing that investors need to take into account is offshore doesn't necessarily mean you're taking your assets to the US or to the Eurozone as an example. You could be going offshore and going to emerging markets where there's actually a pretty strong correlation between the movements in the rand and the movements in those currencies. So you don't necessarily have to take as big a currency bet as investors think. It really does depend on where you go and where you put your assets overseas.
That's a terribly difficult decision, actually, and a very good point you make, Seppo. And Kevin, I'll bring you on this one, because I was looking yesterday on the show with Bronwyn at the performances of various of the indexes over the month, the quarter and the year. And you look at Japan, I think up something like 60% from the low, not year to date, but over the last year, 39% year to date. So if you'd have been in Japan, you would have been fantastic. If you'd been in other emerging markets, or rather emerging markets, your returns wouldn't have been quite so as glamorous. It's almost as though you've got to have a geography degree in order to do the markets these days.
Yeah, it certainly seems so. I mean, I definitely agree with Jeff on your motivation for getting offshore exposure shouldn't necessarily be the rand, trying to time the rand per se, but rather the fundamental investment. But I think I want to add just one more factor that's important to take into account when making any asset allocation decisions, and that's where you are with expectations. And so one of the reasons that the US performed so well during the 90s was because they had a recession early in the decade, and then suddenly there was this increase in productivity which wasn't expected because of IT and internet developments and personal computers. And so the expectations at the beginning of the decade were actually very low, and as things turned out for the US and for specifically the S&P, it exceeded expectations. And so therefore, taking a long-term view, the investment returns were superior to what was expected. And then we had the opposite in South Africa. Well, we had the same thing taking place, but opposite in South Africa during for the following decade. And the late 1998, we had an emerging market sell-off. Expectations for emerging markets in general were very low. And then we had this China come through with higher commodity demand. And so we had an exceptionally good decade for emerging markets because expectations were low at the beginning of it. And the reason, coming back to the S&P and why it's performed so well in the last 4 years, is because 4 years ago the expectations for the S&P was extremely low because of the financial crisis that we were experiencing. And 2 years ago the expectations for emerging markets was perhaps extremely high. And now what we're seeing perhaps is a mean reversion on all of this. So to sum all of this up for offshore asset allocation decisions, but also in domestic asset allocation decisions is, sure, invest in good quality companies at attractive valuations, but attractive valuations, it's important to take into account what is the expectations, and hopefully you're finding an asset that with low expectations that can outperform.
So many questions to ask now, and Jeff, you're going to have to answer them all. Where do we go geographically? Where do we go sector-wise? Is it equities we go for, and if so, what is the equity allocation overseas? Have we missed the boat in the United States? Is Europe still attractive? Japan's obviously shot off. Just sort of encapsulate what we said in the last few minutes, in the last minute, if you would. Nice and easy.
The first one is, if you look at the graph that you've just shown on the screen, it showed the long-term returns of South Africa obviously have been high, versus offshore in the US as a proxy have been lower. If you take simple mean reversion, without a view on the currency, we think that there's probably better returns to be had offshore for the next 5 to 10 years than in South Africa, and that's just mean reversion. We've just had such good returns here over the last 10 years. But then the question is, well, the next step is what guidance do you get from valuations? And interestingly enough, despite the fact that we've had good returns in South Africa and they've beaten offshore returns, there's not strong guidance on valuations. Cape ratio, cyclically adjusted PEs and normal PEs across markets are very similar. The one area that is actually looking interesting though is Europe. And I think that is because Europe's also been priced for bad news, priced for European recession, but probably ignoring the fact that a lot of European businesses, I know it's a favorite at Seppo's, the BMW is a case in point, is actually priced for European bad news, but you've got great opportunities in a global context. So I think that you've got to shop around. Probably Europe, look for areas where there's a bit of depression. I mean, look where take valuation guidance. I think the US is slightly toppish. I think a lot of emerging markets were toppish. They're becoming increasingly attractive. Japan, it's hard to work out Japan because how much of this run is because of a belief that they are going to get Abenomics right, and how much of it is because they're just pumping money into the system to inflate valuations. I think the risk that you face...
I think it's the latter, actually.
Sure.
And Jeff, we'll just hold it there because I don't want to get into too much detail about Abenomics, although I must say we did have a 0.8% increase in Japanese CPI the other day. We're going